I'm Matt Bell, and I'm joined by my colleague Mark Biller for a conversation about gold. That was the topic of Mark's recent cover article in the June issue of the SMI newsletter. And while we devote the most space out of any article to the cover, there's still plenty more to cover on that topic. And so we thought we'd have a conversation about some of those other aspects that we didn't have room for in that article. So, Mark, first off, tell me about the environment we're in. I mean, the article really uses the premise that this unique economic environment that we're in is really ideal for gold. And any discussion about gold tends to center on conversations around inflation or deflation. And so help us locate the importance of gold at a time like this.
Yeah, you're right, Matt. You really can't get into this topic without dealing with the inflation deflation issue, at least to some degree. And I think really, no surprise, the big driver for gold right now are these huge twin reactions that we're seeing to the current economic crisis. So, on the one hand, you've got governments taking on massive amounts of new debt. On the other hand, you've got central banks that are just stuffing the system with liquidity. Both of these actions debase the currency in the long run. You're printing more currency, basically, is the net effect, which reduces the value of the existing currency. In the long run, both of these are very inflationary. Gold traditionally does great in an inflationary environment, think the 1970s. But now a lot of people listening to this are probably going, now wait a second, this sounds vaguely familiar, because we kind of had the same setup going through the global financial crisis a decade ago. And sure enough, at that time, a lot of experts, to a large degree, us included, were expecting a really big inflationary or even hyperinflation scenario coming out of that crisis. Well, that never developed. So having been through it once, we've learned some things, and we now kind of understand better that the environment we're in right now in this crisis, I think the easiest way to think of it is, the economy is going along this way. You hit this economic crisis and the bottom kind of drops out of economic activity. What the government and the central bank are trying to do with these huge measures is they're kind of trying to fill that gap. So they're trying to fill that in and kind of paper over it. And so you're not necessarily going to see an immediate inflationary reaction despite these inflationary actions that they're taking, because you have this offsetting deflationary force during the recession. Now, what I think is likely to happen, and I think that the big difference here from 10 years ago, global financial crisis, is one, I think there's been a pretty significant turn to where central banks and governments absolutely have decided they want inflation now. I don't think that was as clear a decade ago. But at this point, I think that governments and I think central banks have kind of learned the lesson from the last time that, hey, last time we did all this stuff that was kind of new, and we really didn't know how that was going to turn out. And we were really concerned that that might have those inflationary repercussions. We certainly didn't want to kick off a hyperinflation. Well, we did all that and we didn't see that happen. So this time we feel that much more free to kick off the governor and really go for it. So they've acted much faster, much bigger than last time. So those are some differences. And of course, it could be that the economic effects this time are much deeper, and they need to be much bigger too. That's the tricky part. We don't really know how these are going to balance out. But I guess to kind of sum up this little inflation deflation piece, in the short term, it kind of feels like you've got gold in a can't lose position, because in the short term, if, let's say, the economic situation resolves quicker than most people think it will, well, then you don't have as deep a hole to fill. And now some of these actions that were emergency actions to fill that hole actually turn into stimulus because we might not have needed quite that much. And if that happens, that would clearly be inflationary. But even if that doesn't happen, even if we have the longer, more prolonged recession scenario, which personally I think is probably more likely, that in and of itself is going to spur even more debt creation, even more central bank action. And so it's like the longer this lasts, the more of those very same actions that are ultimately likely to light a fire under gold are going to happen. And so it kind of feels like whichever way this turns, it's a good setup for gold. Obviously, it's not like gold can't lose here. There's always, as we always say, investing is about probabilities, not certainties. So even though this is a strong setup, what are we talking about? Maybe what, a 60% probability? I don't really know how to peg a percentage, but you understand what I'm saying, that there's always some percentage there where this doesn't play out quite this way, but it certainly feels like a very strong setup for gold, big picture.
Now, another factor that relates to the conversation about the performance of gold going forward has to do with the strength of the US dollar. So, how does that fit into this picture?
Yeah, and that's a little bit of a tricky one because whenever you're talking about the strength of the dollar, it's always a relative valuation game. And what I mean by that is when we measure a strong dollar or a weak dollar, it's always in relation to other currencies. So right now we've got a very strong best house on a bad block dynamic going on, where even though we're issuing tons of new debt, we're doing tons of stimulus from our central bank, so is everybody else. And in fact, in relation to the size of their economies, the fact that the dollar is staying strong relative to most other currencies tells you that they're doing at least as much on a relative basis as we are. Now, where this really becomes interesting, in my opinion, with gold is while you may not see that strengthening, weakening relative to other currencies, what I think is happening already and what we're going to see more of is I kind of look at it as gold being kind of a fixed point. And all of the other currencies are weakening relative to that fixed point. They may be staying roughly in line with each other, but as a group, the whole group is falling. And I would point to the gold priced in other currencies, which of course almost none of us pay any attention to because we're all US dollar folks. But gold has hit all-time new highs in just about every other major currency already. We haven't seen that in the dollar, and I think that's kind of evidence of the dollar's strength relative to these other currencies, that they've hit new highs in terms of gold prices first. But I think that ours is probably coming. It's just a matter of time.
We saw some interesting dynamics earlier this year when when the kind of the bottom fell out of the market, and we saw some investments doing much more poorly than I think people would have expected, including
Yeah.
gold. And so, what happened there, and what's your sense of the path forward?
Yeah, so you're right. During that initial liquidation phase, the February, March decline, gold fell uh, pretty much right alongside stocks, not to the degree, but the timing was similar, and it was a reasonably um, sharp sell-off. I have to qualify that, while stocks were down like 35% at their worst point, I think gold was down 7.5 or 8%. So it was a lot less, but still surprising because people think of gold as a safe haven. Why is my safe haven tumbling by 8% or 7%, whatever it was, right alongside the market? So that was a surprise. But as we look back in history, we've seen that pattern before. We saw it in 2008. We saw it in past cases as well, where during the initial liquidation phase, gold falls. And I think that that's simply because gold is very liquid. In this year's case, gold was up about 7% already on the year when that hit. So investors had gains. Gold was easy to trade because it's so liquid. So as they felt this burning desire to raise cash, it was an easy sell to raise that cash. Now we saw gold absolutely rocket off of that March bottom, actually a little bit sooner than stocks turned the corner. But over the last month or so, we've seen gold kind of flatten out a little bit. And I think what's going on there is that's the fear trade kind of being squeezed out of this market. So everything we just talked about, the longer term setup with the debasing of the currencies and the inflation expectation, that's all kind of gold's longer term reason for rising. But in the immediate short term, gold is still operating as the fear trade, the uncertainty trade. And so as that fear and uncertainty has really diminished, especially in the last few weeks, as people have been getting excited about the economy reopening, stocks have been on fire. They continue to go higher than most anybody really expected that they might. Gold as a safe haven, just, you're kind of getting that fear just wrung out of the market. And I think you're also seeing some consolidation from gold having really a pretty significant rise over the last 18 months or so, even pre-COVID. So really, gold turned its corner in late 2018. And as we pointed out in the article, in a couple different places, there have been some pretty substantial gains for gold, even going all the way back to that point. So we still think there's a lot left in this gold bull market, but that's why I think things have settled down for gold over the last month or so.
If we do see inflation becoming more of a factor in the future, that'll impact other investments too, like bonds. And so how would that impact the prospects for gold?
Yeah, that's a great point. Bonds of any investment class are really going to be hurt by inflation if we see it. And it's important to point out, we've been in a disinflationary trend for almost 40 years. So it's not a small thing to be talking about a turn towards inflation again. Both in terms of the impact it would have if it did happen, but also just recognizing, look, people have been looking for inflation for a long time and not getting it. So it's not a sure thing that we're talking about. And even if we do see it, I'm thinking more in terms of, maybe 3 years, maybe 5 years down the road, like somewhere off in the medium term here. I'm not thinking immediate. I don't think there's any risk of inflation until this economy turns around. And I don't really anticipate a super quick response or recovery all the way back to where we were. So, but back to the bond issue with inflation, if we do see that, I think that bonds are going to really struggle. I mean, we've got these interest rates that are on government bonds are very close to zero on treasuries. We've got like $12 trillion of negative yielding foreign debt. So you've got bonds kind of locked in near zero. And I really don't think that central banks are going to be able to raise rates to combat inflation because the indebtedness and the debt loads that governments are carrying really precludes that option. They just can't afford to raise rates to combat inflation the way governments have tried to handle that and central banks have tried to handle that in the past. And so if that's the case, you've got a situation where potentially you're kind of letting inflation rip while you're holding these bond yields low. That's going to be awful for bond investors if it plays out that way. Where I think it becomes really interesting as a gold conversation is if bonds become significantly less attractive. We've got 40 years of relying on bonds in portfolio construction as the safety mechanism to keep these portfolios safe. And, I think that one of the interesting things that didn't make it into the article from when I was researching was seeing what historical asset allocations have been in portfolios versus where they are now. Rick Rule, who's the CEO of Sprott, which is the company behind the PHYS fund that we mentioned in the article, I think it was him that was talking about how back at gold's peak in 1981, precious metals made up about 7% of the total US saving investment market share. Now that has declined dramatically since then. And over the last 3 decades, the average allocation to precious metals has been around 1.5%. But by the end of this last year, 2019, that was actually less than 0.5% allocated to precious metals. Now, this isn't a huge shocker because, who do you really hear talking about allocating in your portfolio to precious metals anymore? It's become a stock bond world, the 60-40 world, right? But he points out that if bonds suddenly look really unattractive in an inflationary environment, it doesn't require institutions and pension plans and all these folks that have taken precious metals completely out of their portfolios. It doesn't take them going back to like 7 or 10% allocations. I mean, just a change from the 1/3 of 1% to 1/2 of 1% back to like the 1.5%. That's the 30-year average over the last 30 years. That would triple the demand for gold, just that little move. So will that happen? I don't know. I'm not throwing that out there as a, hey, this is how this is going to unfold and this is what's going to drive gold's price. But what I am saying is just, it's really easy to envision these scenarios that would give quite a tailwind to gold's price really for quite a while to come.
Despite those trends that you just described, there are some investors out there that really like to have a permanent allocation, some permanent holdings of gold. So how do you see that approach versus the more tactical approach to having some gold exposure in your portfolio that is used with dynamic asset allocation?
Yeah. Well, the article I think made really clear what our baseline position is, and that is that we think the best move is to rely on DAA to give you the signals to trade gold tactically. In a lot of respects, gold is kind of like our sector rotation sectors that we see get really hot and then really cold. And you don't really, when you see that happen over time, you don't want to sit in those sectors long term. You want to get them when they're hot and get out of them when they cool off. And I think that that's, for the most part, that's true with gold as well. Now, that said, I don't think it's a terrible idea to gradually build up a small holding of physical gold. And that's the key, the small holding of physical gold. But you would want to treat that as more of a permanent holding. Physical gold is a pain to move in and out of. So you really don't want to be having to buy and sell gold coins. The premiums eat you alive if you're trying to do that. So if you're doing this physical gold accumulation, I almost view that as like worst case scenario insurance that I'm kind of taking out of my main portfolio and just holding that over here as insurance. And I think that if someone's interested in doing that, first of all, I'm talking about, maybe like 1% of your overall portfolio, maybe 2%. Small is the key here. And I would really look at that completely separately from my DAA gold allocation. So if I were going to do that, what I would do is I would buy gold coins. I think that's the easiest way to go about it. And I would keep it small and just look to accumulate that on declines in the gold price, just kind of opportunistically here and there. The gold price has sold off for whatever reason. That's a time I might jump in and buy a gold coin or two to add to my long-term accumulation.
So, but to be clear, you're not advocating that everyone own gold coins, right?
No, no, this is just for anybody who kind of has that itch, that desire to own some physical gold. There's certainly no, this is not any kind of a new SMI thing that we're telling people you need to add this in addition to what you've been doing. We just know, because we interact with so many of you, that a lot of people do want to have, a small amount. And for most people, I think that's partly kind of that worst case scenario insurance, but then kind of in the back of their mind, I think a lot of people are kind of like, I'll probably never need it for that, but worst case, I end up passing down a few coins to my kids or my grandkids, and that's great. And if that's the case, wonderful. One thing I think that readers would probably find interesting in terms of how to go about that. A lot of long-term SMI folks know that Austin opened a gold money account. We mentioned gold money in the primer that went along with the cover article. But he opened an account with them and had it open for quite a long time after the global financial crisis. Now, he closed that a few years ago as part of just tidying up estate planning stuff, simplifying his estate planning. But I asked him as I was researching and writing this article, because I knew he had that experience with gold money. I asked him about it. He said for the most part it worked well. He was pleased with it, but that the storage fees do add up over time. And he found it kind of annoying the way the statements made it difficult to really get a bead on exactly what he owned and what that was worth. And it wasn't as simple as he expected that to be, that part of it. So I asked him, so in the type of scenario that I've just been describing, where someone just wants to have, say, 1% of their portfolio in gold, would you bother with gold money or would you just buy coins? And he said, I just buy coins. So that's not to say don't use these digital gold services or whatever, especially if you're buying more, if you're wanting to dollar cost average on a more formal or regular basis. Those are great for that. But if all you want is, a half dozen gold coins that you're going to buy over the next few years, I'd just go that route myself.
So we'll get on to some reader questions in just a minute here, but let's try to put a bow around the article and some of the other points we're talking about here. There's a lot of moving parts to this whole conversation. So how would you summarize it?
Yeah. So I think first of all, the person would want to decide, do I want to have that small amount of physical gold like we've just been talking about? If they do, let's say that they set that 1% rough target to own. In that case, if I were doing that again, I would be waiting for these periodic pullbacks in gold's price. And again, if it were me, I'd probably be buying 1 ounce Krugerrands just because those are the most bang for your buck, most gold for your dollar that you can buy. Now, that said, maple leafs are prettier. And if you're thinking you might be passing these coins down and want to pay a little bit more to get the prettier coins, by all means, have at it. But then the much more important piece is what you're going to do with your DAA gold allocation. Because the 1% off on the side over time, that's kind of small potatoes. But if you're a 50-40-10 person, you might have 16-17% of your portfolio in gold when DAA calls for it. So um, first and foremost, I want to reiterate what we said in the article. If you want to just keep that in GLD, that is perfectly fine. That is a great tool. We are not down on that approach in any way, shape, or form. The whole point of adding these extra options is just to kind of open the door for people who want to get more aggressive with their gold holdings. If that's not you, end of story. Buy your GLD, wait for the DAA signal, and enjoy your picnics this summer. You don't have to do anything else besides that. Now, if you're one of those folks that wants to get more aggressive, then at this point in the gold cycle, I would recommend waiting on a gold pullback before making changes. Now, I'm assuming that most people already own GLD because DAA has been in it. So if you're looking to get more aggressive, I would wait for a pullback in the price myself. Nothing wrong with doing this right now and not waiting, but myself, I would probably wait. And that's partly just because I do expect that if the stock market pulls back, and it's so hard for me to imagine that it's not going to, even if it doesn't retest the lows, just the kind of rocket ship rise that we've had seems to be begging for a pullback. And if that happens, I expect the gold price and the price of these gold mining stocks would pull back as well. I think you might get a better opportunity if you're wanting to rotate into some of those mining stocks at a little bit lower price point. Now, of course, you also run the risk that you won't get that pullback. And in that case, it's not a terrible situation because you already own the GLD. But I would be looking for a little bit of a pullback here. And if we get a pullback, then I would sell, again, I'm talking small changes, maybe 1 or 2% of that 16. So not 1% of 16%, but you've got your 16. I'm taking 1 or 2 of those 16, and I would be selling the GLD. And personally, I would be looking at this point in the cycle to go into GDX. If you're feeling really aggressive, maybe you split that between GDX and GDXJ, which are those smaller junior miners, but that's adding even more risk. And seriously, even if you're a gunslinger, I would not be moving more than 3 or 4 of that 16, 17, and that would be at the really high end, because these gold mining stocks, I mean, they really can rip. I've been, not surprisingly, full disclosure, I've been playing in and out with GDX for quite a while, actually since late 2018, trying to get a comfort level with it. That's not unusual. Before we recommend stuff to you, we try to actually understand it and really know it well. So I was in GDX when the bottom fell out of the market in February and March. And so I rode it from the high 20s down to like 16 in like 2 weeks, and then rode it from there all the way back up. And I mean, if you were in sector rotation, you know kind of what that was like, but I think this was even more extreme than that was. So you don't want to overdo this aggressive part of the gold portfolio. Keep in mind why we own it in DAA. Yeah, we want that upside, but we also own it because it's a more conservative option. So you don't want to completely undo that by flipping all your GLD for something risky like these gold miners.
Well, obviously, this topic is of interest to a lot of people because that article generated a lot of engagement really quickly and
Yeah.
quite a few questions. And so let's address some of those questions. One of them had to do with silver. How does silver play into this conversation?
Yeah, silver's used a lot more than gold in actual industry, has actual like real economy uses. And so silver tends to trade more with the economy than gold does. It also has a little bit less of the long-term monetary association that gold has because we had a gold standard for so long. That's such a tight linkage. But I think that big picture, what people need to know about silver is it's more volatile than gold. It tends to move later than gold because whereas like right now, gold is kind of reacting to what the government debt and the central bank liquidity situation is. Silver is still reacting more to the economic deterioration that's going on. And so, in terms of the cycle, silver tends to kind of come in at the tail end as a more volatile play. So, I'm not personally super attracted to playing in that particular sandbox. I feel like there's plenty of kick available in the options that we outlined in the article. But I will point out too that if you do go into some of those options, the streamers, the gold mining companies that we talked about, you're getting some silver exposure through those vehicles already. So it may not be necessary to add silver specifically. Beyond that, there are a lot of people that are big on silver right now because we are at a historic high in terms of the gold silver price ratio. And what I mean by that is just the disparity between the price is historically towards gold right now and away from silver, which makes a lot of people think, well, if that reverts closer to how it's been in the past, silver probably has more room to run than gold. And that may be true, but I also think you're going to get that with a lot more potential volatility. And it's a lot harder to figure silver out, frankly, because you've got that economic component on top of everything else that we've been talking about. So, nothing wrong with silver. Just know that you're getting a really amplified volatility version of everything we're talking about with gold.
Another reader asked about the wisdom of holding gold in other forms like jewelry.
Yeah. I think that's fine. Clearly, we'd be talking about that more permanent allocation. If we're talking about jewelry, because you're not going to want to go in and sell your rings and necklaces and whatnot on every DAA signal. So that would be more of a permanent holding. I think for most people dealing with these standardized gold coins, where you are really just transacting for the dollar value of the gold itself in that coin. I think that's a lot easier because as soon as you turn that gold into something else, a necklace, an earring, or whatever, you're getting away from just the pure weight and value of the gold itself, and you're getting into more of a art almost kind of a situation. Um, all that said, if you've got some kind of reason to want to go that other direction, perfectly fine. If if you enjoy wearing that, if you have some insight in that, if you have some kind of connection that makes that easier for you to get, yeah, have at it, because ultimately it's the gold that you're trying to accumulate. And in some worst case scenarios, the horror stories of people having to like leave countries as borders are closing and things like that. Sometimes you do hear the stories about, we were allowed $100 and 3 items of jewelry and that was it, and that kind of thing. So in some cases, more extreme hopefully than we're ever facing, that can actually be a plus, but I don't think it's enough of a plus to outweigh the difficulties of trying to go about accumulating it that way for most people.
We also had a number of questions about owning gold in a taxable account. So what are your suggestions there?
Yeah, so um, there is a potential significant difference with GLD and some of these other tools. We have not historically had very many um, gold signals in DAA where we've held it for longer than a year. Um, so this really hasn't come up much since DAA was launched. But it could certainly come up in the future if things play out the way I've kind of been talking about. It wouldn't be a huge shock to me to see us own gold for a year or more here, or at some point in the future in the next few years. So it is good to be thinking about this. If and again, to be clear, this only applies to holdings in a taxable account. If you own your GLD in an IRA or some other type of tax advantaged account, you don't have to worry about this. If you own your gold for less than a year, you don't have to worry about this because GLD gets the same ordinary income tax treatment that any of these other vehicles do if you own it less than a year. So we're only talking about GLD that's held in a taxable account for more than a year. But in that case, GLD gets taxed at the 28% collectibles rate. And there is a lower securities rate. So any other stock, ETF, whatever that you would own, if you own that longer than a year, you get a better tax rate. And that's where I was pointing out in the article, it's kind of ironic that a vehicle like PHYS, PHYS, which the whole point of that vehicle is that it supposedly is getting you closer to owning your own physical gold. It actually gets the lower securities rate than GLD does. Now, I think for most people, that's the most logical substitute for GLD in a taxable account, because while the daily moves of those two are a little bit different, you're not going to see them walk in lockstep day by day. Over a few weeks to a month, almost all of that gets smoothed out to where when you look at the long-term returns over 3 months, 6 months, a year, 3 years, whatever, they're very, very similar. But PHYS gives you that better tax treatment than GLD does. What you want to be really careful of in this situation is you don't want to substitute something that's significantly more risky, like GDX, just to try to avoid a tax issue at the end, because boy, the appreciation or depreciation difference between those two vehicles could be so much more than the tax difference. That shouldn't be the case between GLD and PHYS, because those walk pretty closely. So that would be my recommendation there.
Okay. Well, we've covered a lot of ground here on this topic, but are there any other thoughts, any final words of guidance or recommendations you'd like to leave our folks with?
Not really. We'll be continuing to check the comments on these articles. So if you heard anything here that we've been talking about that either wasn't clear or that sparked any additional questions, by all means, come back around and ask the follow-up questions. We want this to be as clear as possible. I certainly don't want to give anybody the impression that we've got the gold crystal ball here and we know exactly how this is going to unfold. It's just kind of an unusual setup in that it looks like there's so much potential that it really felt like it warranted taking a deeper dive and exploring some of these other options and alternatives so people can make the best choices.
Okay, well, we'll leave it there. Anybody who's not seen it, the cover article for the June issue of the Sound Mind Investing newsletter is all about gold. You can find it on our website, which is soundmindinvesting.com. Mark, thanks so much.
Thanks, Matt.